As you must be aware, yesterday the Union Budget for 2026-27 was presented by the Honorable Finance Minister. It was a Sunday, interestingly, and yet the government chose to announce it on a Sunday and made a lot of people work on otherwise what is an international holiday. Nevertheless, it took some time for me to go through the finer details. As you know, budget comes out with a lot of documents and annexures and memorandums. So after going through all that, I am presenting my takeaways from this budget in terms of the key announcements. What could be the possible implications of that from a financial markets perspective, and what could be possible actionables that we will take going forward. Let me begin by saying that as a proud Indian, as someone who believes in India's potential to be a superpower, I think budget has missed a great opportunity of positioning ourselves in that sense. Of course, the budget is for India. I understand that it is all about income and expenditure of the government and all the measures that the government will take to ensure that India will do well. We have to understand that India is not one of the smaller countries anymore. We are not the 80th or the 100th country of the world where the rest of the world is not interested in our budget anymore. We are an important country. We are in the top three effectively from a GDP perspective. And we need to position ourselves as a superpower, just like US, just like China, because the rest of the world definitely is looking at India from a trading partner perspective, as an investment destination, as a country that probably is going to be more friendly than US or China when it comes to global geopolitics, when it comes to global trade talks, etc. So from a positioning point of from an optics point of view, I think it is important for us to not just address the budget for internal purposes, but also have that document and that speech which finance minister is giving out in a way to communicate to the rest of the world as well. I do understand the government can do in multiple ways, but I was somehow expecting that from the budget speech and the budget documents also. Why I say so is India is a growing country. We are going to grow much more than where we are now. We are close to like $4 trillion as we speak. We can potentially go to 25, $30 trillion over the next decade, 2 decades. And one of the most important ingredients for that is capital. We need capital. India needs capital to grow. As simple as that. Any country needs capital to grow. And there are two sources of capital for any country. One is internal and the other is external. So obviously we have domestic capital coming in from various sources. But as a growing country, you should always be looking for more capital sources and not try and lock down anything. And for us, I think foreign capital is very, very important. No matter what our relationships could be with some of the countries, we need foreign capital. It's not a question of being dependent on foreign capital. It's a question of, if I'm growing, why should capital not be taken from any source that is coming to us, right? A company will also think like that. From that perspective, the context from which the budget came was foreign investors were exiting India lock, stock and barrel. Starting 2024, foreign portfolio investors who had a very large shareholding of Indian companies for a pretty long period of time, starting the early 90s, they have been exiting starting 2024. And in the calendar year 2025, foreign portfolio investors sold $18 billion worth of equities. It's not a small amount. It is the largest sell-off we have seen in the Indian equities for the last 25 years. And that is capital going out in one form or the other. Foreign direct investments, which is also a core source of capital for India, has also been almost zero to net negative over the last couple of years. Now, this is capital which could have come to India, not coming to India. And there are a lot of reasons for that. Rupee depreciation is one reason. The opportunities that global investors get elsewhere is another reason. US interest rates were high over the last 2-3 years. Obviously, dollar yields were also high. I understand there are multiple reasons, but we need foreign capital also apart from domestic capital. Going into the budget, there were a lot of talks about how our tax structure is not necessarily conducive for foreign portfolio investors who are already kind of losing out from a depreciating rupee against dollar, because please understand, they look at everything from a dollar perspective. They're not looking at from a rupee perspective. So while we may think Nifty has given 10-12%, adjusted for rupee depreciation, maybe they're only getting 5%, 6%. Now, when US treasuries are giving 3, 4, 4.5%, why would you want to take a lot of risk and come to Indian equity market and earn 5%? That was the background. And of course, government for whatever reasons may decide not to address some of those important issues, but to not even refer to it or to not even address it in some form, I think is a positioning miss that we had. Of course, I'll come to the specific provisions, but at a broader level, I think the government, the finance minister, all the communications we are doing officially, I believe has to now come from a position of strength. And we need to kind of go out there and say, yes, you trusted US, yes, China is growing, but here is a country which is also a large democracy, has always been fair in global trades, and we also are growing very fast, which is a fact. But we want to grow faster and we want to attract foreign investors also. There is nothing wrong in that. And I think the government missed out on that leaf in this particular page or book or whatever you call it. So that's my broader disappointment to begin with. Coming to specifics in the same thread is again positioning. I was going through the budget documents of the budget in India's official government website for the budget. Now, as I go through it, there is a very important document which gets released to the press, and you must have seen that in your WhatsApp groups, etc. Is what is called as the key highlights of the budget. It's a presentation. It's essentially a PDF, which is like multiple slides, which talks about the salient features of this budget. If you open that presentation and if you just go through it, you will realize that it's made using PPTs, which probably we would have done in 90s or early 2000s. Very basic. We are talking about wanting to make a digital India. We are talking about a startup revolution. We are talking about AI. We are talking about creating an orange economy, which is about digital leaders in this country. We can use AI to make that presentation also, right? It's a very basic, simple thing because that document is going out and it's a very, very basic document if you go and see how it has been presented. So again, I'm coming from the perspective that we need to now start operating as a global leader and not a third world economy where nobody is watching what India is doing. Everybody is watching what India is doing. So even the documents which goes out, I think has to be at international standards. So that's the expectation which I had. Now coming to what the budget contains, I'll start from macro first. The government is now estimating that in fiscal year 2026-27, the GDP at a nominal growth level will grow at about 10%. So what the government is expecting is that the nominal GDP, which last year was about 357 lakh crores, which is for FY26, will become 393 lakh crores. Please understand, it's effectively 393 trillion rupees essentially, right? So when you convert into dollars, we say whatever it is, close to 4 trillion or 4 point something trillion. Great number. Now, there is a possibility that there could be a global slowdown this year. I don't know how the AI boom will play out. So it's possible outcome that globally there could be some slowdown. Europe is anyways not doing that great. Now in that context, I think 10% expectation from nominal growth is slightly on the higher side. So I think it's a little aggressive. Even for FY26, the growth rate has not been as high as 10%. It is typically between 8 and 9 as we speak. Obviously, the year has not got over. So I think there's a little bit of overestimation on what the nominal GDP growth could be. The real GDP targets we can still meet because real is nominal adjusted for inflation. So obviously we can reduce the inflation, we can control it in such a way that the real GDP can look good. But nominal, I think, is slightly on the higher side on expectation. The second macro indicator, which is very critical, is fiscal deficit. As I said earlier, if we are a growing country, we need capital and government also borrows. Fiscal deficit is government borrowing more than what it spends. And as a percentage of GDP, I think that percentage is on the a lower side, which means it is pretty much on track, which is expected. However, in absolute sense, because the GDP itself is pegged at a slightly higher level than what I think will be, in absolute sense, the fiscal deficit figure of almost close to 17 lakhs crores, I think is slightly on the higher side. And The market was not expecting the figure to be as high as 17 lakh crores. As a result, we have seen a little bit of impact in the bond market today where the yields went up. Higher the fiscal deficit, the government borrows more and that much more pressure on interest rates. So a little bit impact we saw. But again, these are all estimates. So as we go into the year, we will realize how it is. So broadly, fiscal deficit normalization is good, even though the gross borrowing seems to be slightly on the higher side. So that was the macro side. Obviously, the increase in expenditure which the government is anticipating is in line with the nominal GDP growth rate. And obviously, the government has started to increase its spend on capex. This year also the capital expenditure spend has gone up, which is a good sign. Single most important focus from the budget is on manufacturing and making in India, which is a great important segment because again the global context is deglobalization to some extent. Countries are looking inward, trade wars are happening, geopolitical situation is not very good, so every country is looking inward. So from that perspective, you are now looking at more of a domestic consumption market being taken care by domestic production market, right? So we need more manufacturing definitely and not just rely on exports or services. That's a brilliant theme. In fact, the theme started post COVID because when COVID happened and the world was not trusting China because there were kind of beliefs that probably China was responsible for the virus outbreak. There was a requirement for China plus one. And to be honest, over the last 5, 6 years, we could have done much, much better than what we have done. So government has always been talking about the manufacturing story. I think the growth could have been much faster than what it has been. If I look at what some of the other smaller countries have done in the same time period, like Bangladesh or a Vietnam or a Taiwan, I think they have got a lot more benefit out of China plus one as compared to a large country like ours. There are reasons for that, which obviously we can go into in a separate discussion. So that was the macro theme, focus on a lot of manufacturing segments, and there are various segments that government is focusing on, which is great. Now, as you know, the market reacted negatively on Sunday, which is yesterday when the announcement was made. The reason was simple. Market, obviously, like a little baby, always expects the budget to be friendly to the market. Now, it is always like a tantrum throwing thing that saying that, give me some more sops. So they were expecting some rationalization on capital gains, maybe. They were probably expecting some talks about moderation of capital gain over a period of time, etc., which would have benefited foreign portfolio investors as well. Market was not disappointed that what they expected did not happen. Market was just disappointed because what they did not expect happened, which was increase in security transaction tax on futures and options. Now you might probably think that all long-term investors should not be bothered about futures and options. Great logic, but the fact is that futures and options are a big part of Indian markets, even from an institutional perspective, because they use it for hedging. There are a lot of arbitrage funds that uses futures and options. So increase of STT, and not just a basic increase, it was a steep increase in security transaction tax, which impacted market sentiment really negatively, which also essentially threw out that message that I'm not really concerned about what equity markets will do. And that is also a little bit of a disturbing thing for me in the budget. As I said earlier, India is a growing country. We need more capital, and more capital includes equity capital. We are talking about Startup India. We are talking about a startup revolution in India where more and more startups are coming. Startups give exit to investors. How do they do it? One of the most common thing is public markets. So you need to obviously keep the public market liquid, active, and you need to have measures around it to strengthen it. Now, obviously, government is very clear that a lot of futures and options are used for speculative activities, especially by retail, and that is why they're increasing STT. I really don't think an amateur retail trader who comes into the market is really aware of what the impact of STT is on their profit, which is very high, to be honest. Transaction cost is a big part of F&O trades, but somebody who starts off in futures and options as a retail individual is not really aware at that level. They are coming, as government rightly says, from a speculative perspective, which means they generally are not fully informed. And it is probably good to believe that they are not informed about the impact of transaction cost also. Meaning, whatever be the STT, the greed element of traders will continue, I think. Of course, there will be more losses because of transaction costs. So some of the traders will obviously stop because they'll go bankrupt. But thinking that this is a way to stop speculative element, I really don't think that that is a great measure, because speculation slash gambling is not a function of what numbers and transaction cost exist. It's more a function of human behavior. And we have always had gambling as a part of our longest form of traditions in many ways, right? So I don't think STT increase is going to reduce that kind of speculative activity. What it does is it definitely reduces profit, increases transaction cost, and it will impact, as I said, institutional trading also. Example, arbitrage funds. Arbitrage fund is a very beautiful product that mutual funds have, where you can park your short term liquidity and earn yields from arbitrage. And when you do arbitrage, you're basically buying stocks and selling futures. So because you're trading in futures, not from a speculative point of view, purely to earn risk free profit, the transaction cost goes up now, and the returns of arbitrage funds will be impacted. It will get impacted, as per my calculation, by about 0.4 to 0.5% per annum. So if it is giving you, let's say, 6% now, it will probably go down to 5.5, simply because of higher transaction cost. I don't think it was necessary. Also, SIFs, the new instrument which has been introduced in the mutual fund space and in the investment space, they also use a lot of derivatives, futures, options. Their cost also goes up. Effectively, SIF returns will also get affected. So again, from a revenue generation point of view, this measure was not taken. It was probably from curbing volatility perspective. I don't think it will serve that much well. We have increased STT in the past also. In fact, when it was introduced also, market did not like it. And earlier also it has been increased. Net, when STT rate gets increased, the volume somehow comes down because of that, and the net absolute profit is the same. So it doesn't really increase the tax revenue collections for the government. But if the norm is clearly from perspective of reducing volatility, I don't think it is the best way to do it. But then again, it has been done, and market clearly did not like it as the first thing. The next important feature which came out, and a norm which came out, which I think has gone down very negatively in the investor community, and again from a perception point of view as to how do policymakers think in a superpower country, right? That is again something which globally everybody is watching. And I think there is a mistake which the government did from a perspective of taxation on sovereign gold bonds. If you understand sovereign gold bonds, the idea was government said, invest in SGB, I'll give you interest of 2.5%. If you hold on to the maturity of SGB, which is 8 years, you will not have to pay any tax on the capital gain. It's a big advantage. So you're getting all the gold returns, which by the way, till 2 years back used to be more like 9-10%. So everybody thought I'll get 9-10% compounded and no tax on it effectively to hold till maturity. So government was able to collect a lot of money by issuing SGB. SGBs are also traded in the secondary market. So obviously, if you could not buy it in the primary market issue, you can also buy it in the secondary market. If you were then holding it till maturity, the earlier tax logic was you will still not be taxed for capital gain. This time they have modified that rule and they said, you know what? If you have bought sovereign gold bonds in the secondary market, even in the past, if you have bought it, and if you are now going to hold it till maturity, any capital gain that you will make, you will have to pay tax on it. Now, this is unfair. Why? Because when I purchased those sovereign government bonds from the market in 2024 or 23 or 22, I was told that if I hold this till maturity, I will not have to pay capital gain tax. And now you're saying, no, you will have to pay capital gain tax on that. It's not very fair, and it kind of creates a little bit of a perception that tax laws are not really steady and it can change to benefit from the government's perspective. Now, one might argue on the other side, you know what, India is a fiscal deficit country, we need revenue, so why not tax whatever we can tax? Great. So A, you should have done it from day one. B, what is the income that you're getting from all of this? And we did some calculations around it. We looked at what kind of numbers are we talking about, right? So the total sovereign gold bonds outstanding as of today, the ones which are matured is gone. Whatever is outstanding as of today, cumulatively, at an issue price of 65,000 crores cumulatively, all of the issues put together, which means government got about 65,000 crores totally. The gold price obviously has had a stellar rally over the last 2 to 3 years. So the market values of these sovereign gold bonds have gone up because sovereign gold bonds are linked to the gold price. So the market value of all these outstanding bonds is approximately 1,90,000 crores now. So what is 65,000 crores cost has now become 1,90,000 crores. So the capital gain element, which is as of now unrealized, is about 1,25,000 crores. So this much total gains have been accumulated. Now, obviously, this is the total gain on all the government bonds. Let's assume out of this 50% of the government bonds have been purchased by investors in the secondary market, which means the primary market issuance happened, investors bought it, and now they sold it also, and many new investors have bought it. Even if I assume that ratio is very high at 50%, by the way, I don't think it will be that high. Even if I assume it is 50%, the effective tax that the government is going to collect is about 8,000, 9,000 crores. Because the total capital gain tax on this 1,25,000 crores comes to about 15,000 crores. Which means if all this 1,25,000 crores gain is taxed, and by the way, this is gain as on today's gold price. Gold price can crash also in the future and this gain can go down. So what I'm talking about is 15,000 crores of total tax revenue. Even if I assume 50% of that is bought in the secondary market, it is what? 8, 9,000 crores at current price. What if gold price corrects by 20, 30%? This amount is low. We have a fiscal deficit of 17 lakh crores. This tax is gonna give government 8,000, 9,000 crores. Not significant, not relevant, not material. So why disturb something which is not going to benefit? Why create a perception among investors that you cannot rely on what is the tax law currently? It can change. So from a perception point of view, from a confidence building point of view, I think taxing sovereign gold bond is not a great measure. If you are holding sovereign gold bonds, we will advise you individually on what to be done because it all depends on your cost and what is the value today, what what will be the tax if you continue to hold, etc. So all those individual advices you will get, but there will be a decision that we have to make whether to sell it before 31st March because this new rule is applicable from 1st April, or do you want to continue till maturity? It all depends on when the maturity is also happening, right? Because some of us might be holding a bond which is maturing in 6 months, and some of us could be holding a bond which will mature in 4 years. It will have a big difference in terms of decision making. So that we will obviously take for clients, but as a concept, I don't think this was necessary. Uh, there were not a lot of big bang changes that happened. So obviously, it's not like a lot of things changed. Of course, at a individual scheme level, allocation level, a lot of things would have increased or decreased. But broadly, there is no macro impact of any of those in a big way, except the fact that the focus on manufacturing continues, which is very, very important for jobs, consumption, not depending on external world. A few of the benefits or positives which came out from the budget is tax collected at source. When you're doing a liberalized remittance scheme, which is sending dollars out of India, and if you're doing it for certain purposes, you are paying TCS, tax collected at source. For health and education related remittances that you are doing, which is core, right? Health and education is like not luxury or something which is speculative, it's core. The earlier tax collected at source was at 5%. So if you are sending $100,000, you will have to pay 5% of that to the government as tax. Of course, you can claim it as refund later. Now that 5% has become 2%. So there is a slight benefit given to that. It's only, by the way, for education and health. It's not like for all LRS that you do. So, for example, if you're buying a house outside India and doing LRS, the rate still remains at 20%, which was the case earlier also. So that continues, but for health and education, we have some benefit. There is a small element which is benefiting foreign portfolio investors, a small change. They were earlier paying GST on the brokerage cost they were incurring in India. That has been rationalized because technically foreign portfolio investors are outside India. They're consuming something in India. Brokerages obviously have to be paid transaction cost, and they're paying GST also of 18%. Government has removed it. So the global investors will then look all the countries in the same way, because please understand, if multiple countries have multiple tax regime, they get a little confused about what is their post-tax return. So you want to give them a level playing field. So that GST element has been taken out, which is a good thing for foreign portfolio investors. But as I said earlier, just because of that, they are not going to suddenly get excited and come back, because if Nifty is going to give 10, 11% in the next 1 year, and there is rupee depreciation if it is happening post tax. And by the way, FPIs are also getting taxed on capital gains, right? So net they may probably get 5%, 6%. They're comparing it not only with other equity markets globally. India is not the only country doing well. They're also comparing it against yields in US. So that's why foreign portfolio investors, as of now, from a risk reward point of view, I don't think will come back very soon. I think the government is also over relying on the data of domestic investors buying, because last year what happened was uh, $18 billion of outflow from foreign portfolio investors, but market was still okay because the domestic investors were buying, right? Mutual funds, NPS, insurance company. Our SIP book itself is like $1.5–2 billion a month. So that adds up to more than what the foreign investors exited. However, the risk is, and I've mentioned about this in the monthly mailer also, which I sent out recently. The risk is that the domestic investors also lose faith in the market. They also lose patience and say, you know what, we are not getting great returns, because anybody who has started SIP starting 2023 in Indian equity market, their returns are in single digit. So if it continues to be single digit, 7%, 8%, they may probably say, you know what, why not put the money in real estate or gold, which is anyways appreciating so much. And we love returns, right? So automatically it can lead to a situation where Indian investors might lose patience. If that happens, definitely SIP book will go down. If then that happens, there will be less buying and less demand, and that is a big negative for Indian equity market if that happens. So we need to be a little careful about that situation. I don't know whether this norm which I'm talking about will offset it. Highly unlikely. What government has done is government has increased the limit for non-resident investors to invest in Indian equity shares from 5% of paid up capital of a company to 10% of paid up capital of that company. So NRIs, if they want to buy shares of an Indian company, there was limit of 5% of the capital. Now it is 10%. So it's doubled. I don't think there's a long queue of investors wanting to invest more. There'll be little bit of impact for some companies, it will benefit, but not like a macro strong flow of inflow. So I don't think it offsets the risk that I was talking about, where domestic investors might probably lose patience, and that can also be a impact for the market. So that is what the budget was all about. I wish I could tell you more interesting things, but most of it is more operational or procedural that the government has announced. Net, nothing negative for the macro. No sector has been negatively impacted. Focus on manufacturing is good, obviously. However, certain tinkering of things like STT and SGB taxation when they are bought in secondary market, I think all of these things could have been avoided, and then the market would have been like, okay, nothing majorly positive, but nothing majorly negative also. But now the market is a little spooked because of that. So that is where we are. Actionable wise, we obviously will have Indian equity as one of the buckets in your portfolio. As you know, we have an asset allocation model. We always believe that asset allocation is more important than individual sector or an individual stock. So obviously, we will have exposure to all possible asset classes, Indian equity, foreign equity. Again, when the opportunities come in US tech, we will invest in Nasdaq index. There are opportunities in commodities, which we have an asset allocation play on. There will be products like real estate investment trust, infrastructure investment trust, fixed income funds to some extent, conservative hybrid. So it will always be an asset allocation play. At a stock level, at a scheme level, things will change, and any stock portfolio now there will be more churn that will happen. But again, that's a component. At a broader level, the focus is asset allocation should result in consistent growth in net worth, and that is what we are completely focused on at House of Alpha. That is where we are. If you have any specific questions, please reach out to us. Happy investing. Take care.